That is the sound of the Medic's Money financial bleep going off, which means it's time for another financial question and answer episode where we answer listeners' questions. And today we are taking two quite complex questions. One about whether it makes sense to use a limited company for some GP work. And the second question is hideously complex, basically, includes adjusted net income, how to get it under 100 grand, if you're a GP partner or GP getting delayed pension status. So a slight GP focus today. And this is the kind of thing that we cover all the time in our courses for GPs. And you can find out information about those at medicsmoney.co.uk/courses. We have a course for GP registrars, and we also have a course for all other doctors. But by the time you're listening to this, you've probably missed that because it started on the 22nd of May. But check out medicsmoney.co.uk/courses if you want to come and learn from the best. And the best today is Andy Powell, specialist medical accountant, familiar to all podcast and YouTubers listening and watching. Morning, Andy. How you doing?
Yeah, morning, Tommy. All well here.
I hope that you've done some financial limbering up because these two questions are at the more complex end of the spectrum. Shall we start with the first question, which I think actually came from inside our Medics Money partnership community, which is 600 partners all working together with help from the very best in the business, like Andy, all working together to improve the running of their GP partnership. So the question is, I saw you're doing a podcast on extra work. I'm a GP partner and we're trying to move our private work, reports, cremation forms, vasectomy service, and travel IMS into a limited company, but our accountant states that this is not possible. Could you give us some ideas, if possible, on what is allowed to go through a limited company? Is it just reports, or could we be putting through our vasectomy service as well? Also, if we do have a limited company, what can it be used for? Look forward to hearing your response.
Quite a simple question. The answer is quite complex, really, and it covers many, many areas. We need to have a look at the tax side. We need to have a look at the commercial side. We need to consider the pension side as well, potentially. It's a question that comes up quite frequently. This and I don't. What you got to get to the bottom of this is what the driver is to doing this. Often people sort of see headline tax rates and assume that actually having your stuff going through a limited company can save you tax, because if you look at actually what a company does, a company pays tax under something called corporation tax, and corporation tax rates vary between 19% and 25%, depending on how much income you earn, or profit you earn. Sorry, not income, profit you earn through that company. So that sounds quite attractive if you're paying tax at 40% or maybe 45%, or if you're in Scotland, even higher rates. So it looks like you're paying a lot less tax. So actually, why don't we all use companies? But then there's a secondary tax you have to consider, that when you take money out of the company, because ultimately you want to get that into your personal bank account and spend it. When you pay tax and you take money out of the company, there's then a second tax point. You can either take it out as a salary, which becomes taxable in the same way as other income you earn, or you can take it as dividends. And dividends, you can pay tax at 3 different rates. Most GPs will be in probably the 40% tax band, so they will be paying a dividend tax rate of 33.75% on any dividends they take out. So you combine that with the corporation tax, and actually you can end up potentially in some situations paying more tax through a company than you would have done. So why do people use companies? Well, the benefit comes where you can actually start moving that money to other family members who perhaps pay tax at lower rates. So if you're only a basic rate taxpayer, so someone who earns under £50,270, you'd only pay a dividend rate of 8.75%. So that could be more attractive than your current 40 or 45% tax. So if you've got a company where you can actually start moving money, having shareholders who are spouses, then potentially there's a benefit there. But you've got to be careful, because commercially, in a partnership situation of GPs, you may have 3 or 4 GPs, maybe more, coming together. If you start then having to bring spouses in to that arrangement, you've then got a partnership of, say, instead of 4 people, now potentially 8 people. And when things can go wrong in relationships, that can cause you significant issues. And everyone's tax position is different as well. So some people will have spouses who are higher rate taxpayers, so there's no real benefit for them. So from a tax perspective, I wouldn't be persuaded just purely to set up a company for tax purposes. There are also benefits around just controlling. If you're very, very high earning, it becomes very useful. Certainly for consultants, it becomes useful in terms of private practice, or very high earning GPs, it can become useful. If you did have a company alongside your GP partnership, you then got to consider some of the legal issues. And at the moment, your partnership's governed probably by a partnership agreement. A partnership is very flexible, and generally with GPs, when they chop and change sessions quite frequently, and they can, in a partnership, quite easily change their profit shares to match that. If you go into a company situation, you've then got companies are owned by, effectively owned through things called shares. So each individual person will have a shareholding in the company. And then you've got to consider, well, actually, if someone changes in the partnership, to automatically have to change all the shareholdings in the company. And changing shareholdings in a company are a lot more complicated than changing a partnership profit share. So it produces some problems there. From a regulatory viewpoint, you have to think about CQC. If you're just doing reports and things like that, I don't think CQC is an issue. But if you're starting to provide medical services, so I think the question referred to things like vasectomy services. Well, if a company is providing vasectomy services, that is then starting to provide medical services direct to patients, and therefore throws in the question of actually you may then need to register that company independently for CQC. So that's got additional costs and additional compliance issues to deal with. So you'd have to be very careful about what services you put into the company purely from that regulatory viewpoint. The other sort of contracting legal condition you've got to consider is actually from what services you can put into companies is actually the GMS contract. So the GMS contract, or indeed PMS, which is the bit that governs the rules for providing the core services a GP practice does to its patient population. There's clauses in there that actually prevent you from subcontracting to a company where you actually own that company or your family members own that company. So you can't sort of just shift a bunch of money from a partnership into a company without carefully considering what services you're doing, what money you're actually shifting, and whether it's a breach of the GMS contract as well. So from a contracting viewpoint, you've got GMS and CQC to think of. From a pension viewpoint, you've got to consider that actually once you move it out of a company, it ceases to become pensionable income from an NHS pension purposes. Now, if it's private income, it won't be anyway, but it does change the calculation slightly. Now, that could be a good thing. So some people who are high earning, who have been affected by the pensions and the allowance tax charge, and I know that allowance has gone up, people will still be affected by that. If they can look at shifting some money out of that sort of pensionable income bracket, that could be quite useful. So there are pros to doing that, but again, not everyone's in the same boat. But actually, the cons are that if you're not affected by the annual allowance tax charge and you are shifting potentially pensionable profit into a company and make it non-pensionable, then you have to consider the long-term impact in terms of your pension. And that often isn't considered. So many locums, a good example of locums, get a lot of stuff about locums, going to set up companies. And I rarely see in the advice people are given by non-specialists anyone talk about the pension scheme and the pension growth. And I think that is, huge. You're giving up a substantial amount of pension growth in your early career, which compounds over your lifetime, which will have quite a substantial impact down the line. So pensions have to be considered as well. I'm not coming to great conclusions here because I'm just chucking in loads of issues to think about. Again, a separate company, just a reminder, it needs to run independently. It's a separate legal entity, so it needs its own accounts. It needs its own bank account. You can't use your own bank account or the current partnership bank account to shift all your company income through. It's got to be completely separately contracted. It's got to have separate letterhead. You've got to be careful you're invoicing from the company, not from the partnership. You've got to have all the indemnity side covered, that you're covered for work you're doing through the company, not personally. The costs come with that as well. So there are costs of running a company, so you have to factor all those in. So generally, you would sort of say that, if you're just looking at shifting a small amount of private income, it's not going to be worth it because the costs will outweigh it. You're not going to get great tax benefits. You're just going to get a lot of hassle from doing it. But if you're looking at perhaps setting up a whole heap of different services outside the GMS contract, which have some contractual risk, and you want the limited liability wrap around it, then potentially there could be benefit there. So lots of things to consider, really. I'm not a fan of doing it particularly. I think it's worked well where you have perhaps, if you have a classic husband and wife partnership, putting that in, who are high earning, putting some of that into a company might be useful. But if you've got multi partners who are all different, who have all got different backgrounds, different earning levels, chopping and changing sessions all the time, then I think a company become particularly messy to run. So I wouldn't particularly favour it. I've probably not answered the question there. I've just chucked loads of issues at it.
No, I'm going to say the opposite. That is just insanely useful, because a non-specialist medical accountant just wouldn't be aware of almost everything that you just said there. Because the sort of simplistic mantra of should you start a limited company or not is, essentially, if you are going to need to draw out all of that money from the limited company in order to live and spend day to day, then in general, not advice, my oversimplification of the situation would be, it's probably not going to make sense, because everyone sees the headline corporation tax of 19 to 25%, depending on how much your turnover is. And they think, great. But actually, if you're going to take all that money out of tax, you're going to pay income tax on that money as well. And it is at a slightly lower rate. So that's my gross oversimplification of the situation. But the other end, in some situations, it can make a lot of sense. But I don't think many non-specialist medical accountants would understand and have the depth of understanding of everything that you talked about. You talked about the impact on the partnership agreement, the CQC, the need for that, possibly, the effect on the GMS contract and the restrictions about limited companies there, the effect on the NHS pension. Like you said, we see so many locums who are advised to start a limited company to save tax, and no one has even had the discussion with them about the impact on the NHS pension, which is absolutely crazy in my view, and just shows to me that they're almost certainly not using a specialist medical accountant. So although you came to absolutely no conclusion, that was seriously useful to me, and I hope that it's useful to the audience.
Yeah, there is. I mean, there's a further point I've just realised I didn't cover, which is it's a fairly big point. Is around there are, if you're looking at sort of trying to subcontract services from your partnership into a limited company. So you're going to say, let's subcontract our quaff management work into it, for example. Even assuming you can get around the GMS side of things, you've then got to look at the tax regulations, and from a tax viewpoint, there's some quite tricky regulations around what's called off payroll working, and that's basically where if you are a partnership, so if you're providing NHS services, so this covers general practice, but it also covers private companies as well, but certainly covers general practice because they're covered by the public sector side of the regulations. If you're subcontracting services to someone else through what's called an intermediary, which is what a company would be, an intermediary thing that sits between the person that's providing the actual service, the human being, and the people that are subcontracting the partnership. Then you've got off-payroll working rules to look at, and you've got to look through that as to whether actually this is a genuine self-employed relationship or actually whether it's employed. And HMRC can come down and say, no, sorry, this is just an artificial arrangement here. You're trying to channel stuff through a different company, and we want to tax that as employment income on the people who are ultimately receiving it, in which case it wipes out the benefit as well. So, and there's a whole heap of compliance that goes with that. And general practice, I mean, hopefully no one from HMRC are listening to this, but general practice isn't very good at that compliance on off-payroll workers at the moment.
I don't think there's anyone left working at HMRC. Can't phone them, can't email them, can't speak to them. So don't worry, don't think there's anyone left there working. Okay, yeah, that was really, really helpful. Just to think around the issues. It's not a simple issue. I was worried at the start when you said it was a simple question. It kind of was a simple question, but the answer was definitely not simple. I hope that was useful to the person that asked the question. The next question comes from our YouTube comments section, which is actually, I thought it would be a cesspit of people giving out hate, but actually our YouTube subscribers are amazing, And there's some amazing questions in there. Most of them we try to answer in the comments and direct to resources on our website. But this one was just too complicated to answer on, in the comments. So we're going to answer it here, and it comes from @GrimDave, who is a subscriber. Thanks for subscribing, GrimDave. He says, or she, thanks for an excellent video as always. My question is, are you able to retrospectively put money into a private pension after the tax year has ended to reduce your adjusted net income for that year? GP partners often don't get their accounts finalized until 6 months after the end of the tax year. So it's not possible to know exactly how much money to put in the pension to reduce the adjusted net income below £100,000. Any tips regarding this? So, Andy, can we start simple, please, and then go super complex? Like, what is Grim Dave talking about? Adjusted net income under £100,000. This is going to affect not just GPs. And then should we build it up slowly from there? And if I get anything that I think is too complex, I'm going to jut in and ask you to clarify.
Yeah, so really important. So this doesn't affect just GPs. So if you're any consultant or anything else listening to this, do not switch off. This affects you. So this affects anyone who is in the NHS pension scheme. So basically, there's two issues here, really. So what the underlying question here is, someone wants to get their adjusted net income below £100,000. Why does that matter? There's two reasons, really. Firstly, adjusted net income is essentially, in summary, all the income you earn. So income from your partnership or your employment, less any pension contributions, but plus all your investment income, plus rental income, any other income you've got that's taxable. So basically, all your taxable income, less tax deductions, which are pension contributions, loan interest if you are a partner that's bought into premises. And the other thing is gift aid, just to consider that gift aid actually helps bring that down. And I'm going to come back to gift aid in a second, because that's a good planning tool potentially there. If you go above 100,000, once you've done all that calculate, go above 100,000, two issues really arise. Firstly, you start paying tax at a higher rate on that extra marginal income. So we talk a lot in Medic's Money about marginal rates of tax and why they're important. And basically, the marginal rate of tax is the tax rate you're going to pay on that extra bit of income you earned. And between 100,000 and just over 125,000, effectively the marginal rate of tax is 60%. And the reason is that you start to lose, for every £2 you earn above 100,000, you lose £1 of your tax-free personal allowance. So it effectively loses, it results in a 60% tax rate. So you start to pay 60% tax on everything you earn, which doesn't sound great, considering you're paying national insurance and pension contributions as well. That does impact in terms of your take-home pay. But the second issue particularly is around those people who have children. They are using the tax allowances to help pay towards childcare. If you have someone in your family that earns above £100,000, bang, you lose it. It's not even graduated. It's a kind of all or nothing kind of thing. So certainly, if your children are in that sort of that phase of life where you're using that, then you can lose some substantial amount of tax benefits. So people are very keen to get below the 100,000 barrier. So how do you do that? And so the question here is one of the things I said, when you work out adjusted net income, you obviously add all your income together. That's fairly obvious, but you can take certain things off that, and you can take loan interest through, for partnership loans. Well, we'll just ignore that. That's not going to particularly change. But you can take pension contributions off, and you can take gift aid off. So pension contributions are a way of potentially getting you below that. Now, the problem is with a pension, you only get the tax relief on the pension in the year you pay it. So we are now in the 2024-25 tax year, which commenced on the 6th of April. So, Tommy, if you went and paid a private pension now, you'd only get that tax relief on that in 2024-25. It would not be able to carry it back to 2023-24. So the instant answer to the original question, are you able to retrospectively put money into a private pension after the tax year to reduce your adjusted net income? No, you can't. It does not work. Okay. I'm going to come back to gift aid separately in a second. So that leaves a problem, and this leaves a problem as to whether, why are we talking about private pensions again? We had years of not talking about private pensions because of something called the annual allowance pension tax charge. And basically, what the annual allowance pension tax charge was is if you were given an allowance each year, it used to be £40,000. If you were below £200,000 of income, but we'll assume everyone is for the purpose of this, and that was a measurement of your growth in your pension. And most sort of consultants, GPs around this 100,000 barrier, would have used the majority of that allowance up just through the pure growth in their NHS pension, because there are different rules that apply to the NHS pension calculation. So it didn't give you an awful lot of scope for doing private pension contributions. Secondly, we did have a second tax charge, which was called the lifetime allowance, which kicked in when you took the pension. And actually, most doctors would have been in excess of the lifetime allowance tax charge just through the NHS pension alone. So you were kind of potentially going to have two double sort of tax hits of paying additional pension contributions, which meant for a lot of people at the sort of higher earning end, it really wasn't relevant. What's changed is the annual allowance you get each year has moved to 60,000. So actually, there will now be a lot of GPs and consultants in those earlier sort of lower grades where there is scope. It's not going to use that whole 60,000 allowance up. So potentially you can do private pensions. And secondly, the lifetime allowance has been abolished. But big caveat here, big caveat here is Labour said they're going to bring it back. But they're going to protect doctors in some form, but they have got no information on this thing out this weekend, which is, when we're recording this, was midway in the Times over the weekend, about Labour saying definitely going to bring this back, but we're going to have some kind of protection for doctors, but haven't given any detail. So they're kind of going to a bit of an uncertain period of going, well, if they do get elected and they do something about this, do they bring lifetime allowance back? Is it worth doing? It's quite difficult to plan in that respect. But then, so the question is, if you're going to use pensions to try and get below the 100,000, you have to kind of do it in the tax year, which means you are going to have to kind of predict your income and going to have to kind of predict your pension growth. If you're, again, a GP, problems are you don't know what you actually earn because that's based on your profits. So ultimately, you're going to have to estimate that as much as possible. You then have to calculate the potential pension growth, which as a GP is probably, if your pension records are up to date, a lot more simpler now, but there's a big if there because pension records still are out of kilter. If you're a consultant, be very careful in the short term about doing this because the recent uplifts in consultant pay are going to probably result in some pension growth for consultants in the short term, which could use a lot of the pensions annual allowance. So just be very careful there. But you are going to have to predict in year to do with that. The other thing just to consider and just to chuck in at this point in time is gift aid, because I said gift aid is one of those things where it does help reduce that adjusted net income. It can get you below the 100,000 level. Gift aid, there is the potential to carry back. Okay, but you have to do it in certain ways. And you basically, if you make a gift aid in the following tax year, gift aid payment to charity, you can carry that back to the previous year. Now, the way gift aid works is the charity gets the basic rate tax direct from the government, but if you're a higher rate taxpayer, so someone paying 40% and above, you claim the additional amount on your tax return. And the way they do that is just by increasing your basic rate tax band. So if you make the claim on the following year's tax, you have to make the claim when completing your next year's tax return. You have to have paid those contributions, obviously, but you have to actually make a physical claim on your tax return and not a amended claim, not going, I remember now, I want to carry it back. You've got to do it at the time. You can actually carry back your gift aid contributions to the previous tax year. And that could become quite useful if, say, you ended up just at, say, 101,000, 102,000 pounds of income just because you did a bit of overtime or, your GP profits were slightly higher. Then potentially, if you can afford it, actually, the maths may work that actually making a retrospective gift aid contribution to get you below that level might work for you. I mean, clearly, if you're 20, 30,000 over, it's not, you're going to have to be very generous to charities and you're not going to get that back in the additional tax you save. But it's something worth considering if you're just really marginally in that sort of just over that 100,000 level. But yeah, it's difficult, but possible. but it's all about planning. So anyone in this kind of situation probably does need to take some advice.
That was awesome. I just wanted to, so going back to Grim Dave's, what Grim Dave needs to do, the answer to his question is, it is possible, but you're going to have to be seriously organized, because what Grim Dave's going to have to do is know what his profits are going to be for the year, for that tax year. And in order to do that, he's going to have to, rather than just wait till the annual meeting with the accountants and sit down and then get a surprise to be like, how much they made, they're going to have to be proactive. They're going to have to prepare management style accounts in their GP practice so that they know reasonably accurately how much profit they're going to make. Is that right?
Yeah, and a lot of practices are getting their heads around this now. Not just for this purpose, just in terms of general forecasting. And there's some really good software packages out there which we talk about all the time to help practices do this, to get more grips of their finances. And it's part of our GP partnership course that we talk about all the time. Is actually practices have to take ownership of their finances. And ownership means actually not just waiting to the end of the year and going magically, oh, look, we've earned this amount of money, or we haven't made as much as the previous year. You need to know where you are now. If you can do that, you can get a more accurate projection. You're not going to get it 100%. Okay, you're definitely not going to get it 100%, but you'll get it close. You'll have a better idea.
Yeah. Okay. So that's step one. And like you say, that's something that we really major on in our GP partnership course. It's a game changer, really. The days where partners could just sit down wait for the accountant to surprise them at the end of the year. I think those days are over, really. And you need to be knowing what you need to run it like any other business, like month to month. How are you doing? Okay. So you've done that. You know what your profits are. Then you need to try and calculate your growth in your pension. And the reason you've got to calculate the growth is you've got to work out how far off the annual allowance, which is the total amount that you can save in the pension per year, which is 60,000 unless you're tapered. We should probably mention that. So how would you go about doing the growth?
So, but potentially that's going to become a bit easier. Because one of the changes that the government did accept following, a lot of pushing from the likes of the BMA, the likes of ASMA, was around actually how the pension growth is calculated. And there was something called an inflation disconnect, which is causing mayhem with some of the figures. But effectively what they've done is they've taken the inflation issue out of the question. So actually, if you think about your pension is probably in two different pots at the moment. It's in the 2050. Everyone is now in the 2015 scheme from the 1st of April 2022. So all future benefits going forward will be in the 2015 scheme. That is reasonably predictable in what you get the calculation in terms of growth, because it's everyone's in the same boat. You take your annual pensionable income, what your pension's gone up by is 1/54th of that for the year. So if it was £54,000, your income, then your pension will grow by £1,000. But all the previous benefits also go up by 1.5% plus inflation. But you can discount the inflation factor now, which is great. So you can actually just I know built up to date was, £2,000 a pension. You can, apply a 1.5% uplift to that, and that's your growth. So the growth is the combination of the two. And then you kind of take what the pension's gone up by and multiply it by a factor of 16. The slight difficulty is the legacy stuff. So everyone will be in a legacy scheme, be it the 1995 or 2008 scheme for all pension benefits, probably up to the 1st of April 2022 now, following the McLeod rectification. If you don't know what McLeod is, look on our website. We've got loads of information on that. But they will be in the legacy part. Now, that legacy part for a GP, assuming your pension records are up to date, is again a bit more predictable in terms of how it's calculated, because you've always been on a sort of career average earnings scheme basis. If you've been in a hospital post, though, there is an element of final salary link that's still retained to that. So if you do have jumps in your final salary, and that's the whole time equivalent salary, then you just have to be careful, because that can result in growth in those legacy schemes. Is it easy to do individually? No, it's not. That's why there's a whole load of experts out there who get together from time to time and still get puzzled by some of the things out there. So you can have a try yourself, but just have to be careful, really.
Yeah. Okay. So that's the growth. Then you got to maybe think about, we didn't talk about this, but we should briefly talk about carry back annual allowance, right? Because we said the annual allowance is 60,000. It's gone up from 40,000. It goes down if you're tapered, but you can also carry forward some unused, if you have any, annual allowance, because this is all going to help Grim Dave to work out how much he needs to, or he could theoretically put into his private pension, right?
Yeah, so you can get so with the way the annual allowances work is you have to work out what your annual allowance growth is for the year and compare it with the allowance you get. Now, as I said, that's moved to 60,000. Just again, caveat here: if you earn above 200,000, that starts to get potentially tapered down. So just be careful. But we're assuming everyone listening is below that level, so you get 60,000 allowance. If say your growth figure came out at 45,000, you've got 15,000 of unused relief to carry forward. And you can carry that unused relief forward for 3 years, for the next 3 years. So in any year, you can look at what your position is in the current year, plus the 3 years before of unused relief. So potentially it gives you more unused relief for annual allowance purposes. So you do have to carry on doing this kind of rolling calculation.
Yeah, HMRC, don't want to praise them in front of an accountant, but their annual allowance calculator online, pretty good. You can go back many, many years, and you probably want to go back more than 3 years to make sure you get it accurate.
Yeah, again, just quick caveat with that is the McLeod side of things is going to change all of this. So, listen to one of our McLeod podcasts or, again, look on our website because all those calculations are going to be retrospectively changed. So, yeah, I'm not on pro advisor here, but sometimes taking some advice is important.
You started to see why we didn't answer this one in the YouTube comments and decided to make a separate video about it because it's at the more complex end. I'm trying to help Grim Dave out here, trying to help a fellow GP partner out. But honestly, like the answer to this question is probably get expert advice. And this is something that I do personally every single year because I don't want to sit down at the end of the year and get a surprise from my accountant that this is how much we earned and a surprise that I got an annual allowance tax charge that I wasn't expecting. I want to be proactive and I want to try to predict it and work out how can I maximize these allowances. So practice accountant takes care of almost all of that, an excellent specialist medical accountant. And you get a IFA that can model the numbers for you to do the calculations. So at some point, you got to say, look, you do need expert advice. For me, I just get my advisors to do this because I got other things to do, like being a GP, running Medics Money, seeing my family. And if you are doing this yourself, good luck. That's what I'm going to say. I don't know. Like, we've got to say somewhere there's a line of, I think, to be aware of the issue and the potential allowances that you can change and the reliefs that you're entitled to and how to maximize them and how to get your GP partnership accounts so that you don't just sit down at the end of the year and get a surprise on how things went, how you know month to month using software what you're going to get. That's definitely something you can do themselves. And after that step, I'd be tempted to just hire an expert. Andy, what do you think? I mean, it's hard for you because you are an expert, so you could do it yourself. But for me, as a layman, I think that's where my personal limit is. Like, I'm totally comfortable getting my GP accounts up to scratch. I know the theory, but I always appreciate the benefit of expert advice in these really complex things.
Yeah, I mean, you've got to take control of what you can control, and what you can control is take control of your business, which is kind of what and your
100%.
business finances. And if you do that, actually, your business will operate automatically better. If you look at sort of the what are some of the key factors of successful businesses and successful GP partnerships? One is from lots of different factors, but one factor is those that are really over their finances and know where their income's coming from and can identify where they're losing out and where they're going to make savings and where things are. So that's what you've got control of. You haven't got control of all this tax technical stuff and pension technical stuff. Yeah, there's some very good experts out there, and I would use them. Lots of people out there in the profession I work with who I'd happily recommend, and lots of people we work with at Medics Money.
Yeah, definitely. It's exactly why we sell Medics Money. You can get matched to an expert that's matched to your personal circumstances. Over 10,000 doctors now have used that service. So, okay, thanks so much for your questions. If you've got more questions and you're watching YouTube, drop them in the comments. We'll try to pick up as many of them as possible. We tend to go for questions that can benefit everyone, so that ask a question that isn't too specific to your individual circumstances. Like, moved from Australia to Ireland to Belgium and now back to England. What do I need to do about my personal taxes? Probably not going to take that one because it's pretty niche, but something about adjusted net income or pension that's going to help our audience. We are more inclined to answer those. So keep asking questions. If you're not subscribed and you want more, hit subscribe. If you're watching on YouTube, hit the like button. If you want to come on one of our courses to learn more about managing your finances, whether you're a doctor, a consultant, or a GP, I'm distinguishing GPs from doctors there. Going to get flamed in YouTube comments. I need a rewind.
I did think that, Tommy. I think let's rewind that one.
Sorry, fellow GPs.
Don't let this go out on Twitter. That's it.
Yeah, so we've got like doctors and then we've got GPs, like totally separate, right? Oh man, I can't remember what I was saying. Something about our courses. Go on medixmoney.co.uk/courses. We've got courses for all doctors, including GPs, including GP partners. Just go to medixmoney.co.uk/courses. Oh, and Andy, as ever, thanks. That was mega. Like, hopefully that wasn't too detailed, but that was awesome. So thanks for that. Take care, everyone. See you on the next episode, unless you decided to never tune in again because I distinguished doctors from GPs. I'm sorry about that.
Bye-bye.